The chart that I have in front of us is that of the Nifty 50. As you can see, from its high formed on 27 September 2024 at 26,300 approximately, Nifty has corrected almost 1600 points, creating a low of approximately 24,700, and all of this has happened in the span of 1 week. Therefore, the question that has been asked is this the sign of a bearish trend, and should we cover our long positions and begin to go short in the market? I have tried to answer this question in a manner of framework which I will outline in this video below. So like most things, let's start off first with the analysis of the market on the broader time frame. And the only question that I have to the viewer, that is you, is that what do you make of this chart? Is this up or down? Very often when this question is asked, individuals begin to create subjective narratives around the price action, such as explosive moves, overbought, consistently trading above certain levels, strong breakouts, failure, breakdowns, etc. The only question that when we look at a longer time frame is the security up or down? And if the security is up, then the plan becomes very easy, that we want to buy the dip. Since anyone who is serious about investing, they would typically be looking at the monthly charts in order to establish a generally sustained long-term trend. So here we can clearly see that the high that was created last month is without any ambiguity a life high, and which I will mark as a higher top right here. Sorry. And now the only question is that if a security is creating a higher top, is the trend up or down? And the answer is obviously up. So an investor should not consider completely giving up positions or leaving the market if the trend is upwards. The only premise for leaving the market is the formation of a lower top, lower bottom pattern on the time frame that they consider as a trend time frame, which for an investor should be the monthly charts. Let's move on towards understanding the view of a positional trader. So the positional trader is going to most likely take their decisions on the weekly charts. And on the weekly charts, the positional trader can clearly see that the recent pivotal value was a higher top. And since traders have a slightly shorter time frame, and at maximum, that is, they could have a time frame of 3 months, because 3 months forward contracts are available for trading in the market just now, they will typically evaluate what was the previous pivotal low and answer if it is higher top or higher bottom. And as we can see here, that this low that is created around this candle is clearly a higher bottom relative to this low right here. Which in turn is a higher bottom relative to this low. So a weekly trader or a positional trader is also seeing a security create repeatedly higher bottoms, and the previous price action resulted in creation of a higher top. Therefore, even positional traders should consider buying the dip. That is, once we know that a security is structurally trending upwards, our plan in the market is to buy the dip. And let us analyze this a little bit more. Once we have established that the trend is up on the weekly time frame, any positional trader will now move to the daily and try to establish the plan of action. Since the trend has been decisively answered as up on the weekly time frame, the study or the analysis on the daily time frame should only be on the long direction, and all that we look for on the daily time frame is a confirmation of a bias which is set on the weekly time frame. So the trader on the weekly time frame is seeing Nifty definitely having created a higher top, but in such a case the higher bottom in here would have been at this level, which has been marked now, which is 24,750, which was formed in September 24. Incidentally, the current low that is created is also around the same place, and in the process the market has now created a double bottom. Now we know that any uptrending security must create higher tops and higher bottoms, but here we can see that in the process of the pullback that was initiated last week, the market has created a double bottom. And when this happens, it is very clear that the trader is currently seeing the market in a range. And when the market is in a range, we can trade in both directions, which is the long side and the short side. But as I have explained, even in the courses that I have taken before, that the trader should focus on the direction or the bias that has been established on the longer time frame. That is, in the longer time frame, which is the weekly, we know or we had already set up that this is an uptrending security. Therefore, if the security on the daily is creating a range, it is our objective to be on the long side of the range till the trend on the weekly changes decisively. Now we can see that 24,750 or 24,700 is a decisive range bottom. But how has the market formed this range bottom? We have to zoom in a little closer and we can see the green candle that the market had formed on 8th of October. This green candle, which is completely enclosed within the body of the candle formed on the 7th of October, is what we would call an inside day candle. So right here we are seeing an inside day candle. As we know, an inside day candle is basically a bullish reversal candle. But like most bullish reversal candles, with the exception of the hammer, this candle too needs a confirmation, and confirmation will be broadly of two types. The first one is that there must necessarily be a green close. So I will write it here. In confirmation, the first one is necessarily a green close. The second one is a close above the previous high or the confirming high. So what do I mean by this? We can see that the inside day was created on the 8th, and we can also see that the high that was created was 25,050. What we are looking for in matters of confirmation is first of all a green close, and secondly a green close that is significantly or at least higher than the high of the candle that created the bullish reversal pattern, which is the inside day. Now since this has formed, we can see that the market has indeed gone and made an intraday high. However, the market has failed to close in green, and it has definitely failed to close above the previous high of 25,050. Therefore, we can see that the market is in a range, has created a double bottom, has created an inside day pattern, and we are awaiting a confirmation of this pattern in order to initiate longs. A trader can make the system slightly more sophisticated by adding a particular oscillator. For example, if a trader were to add RSI, and since we are analyzing the trend on the weekly and have shifted it to the daily, that is 1/5, we will select the RSI to 5. And now what we see is that the market is indeed highly oversold, and it has created an inside day candle under highly oversold conditions at the double bottom of a security which is structurally bullish trending. All that we wait now for is a confirmation on the closing. To get a sense of direction, another assessment that traders can do is to evaluate charts which are highly correlated with the market. One such popular chart being the Bank Nifty chart. We will repeat the exercise as traditionally has been done, which means first step is to establish the trend the trend on the monthly, and we can see that clearly there is a higher top that is created here, and therefore any security which creates a higher top has to be on an uptrend. This is established from the perspective of an investor, which means if you are an investor looking to invest in banking stocks, you know that the trend is in your direction, and all that we have to do is wait for pullbacks at reasonable supports and enter on confirmation. Such is the premise for an investor. But let us move to the understanding from a positional trader's perspective. And from a positional trader's perspective, we can see a higher top that is created here. But if we go more closely, we see that in relation to the previous top, we can now seeing a double top. Of course, the market has created an objective value as a new high, but this high has not been sustained, and therefore I would consider this as a double top. Furthermore, when the market had created a previous high, we can see the support at the value that I have marked here with the horizontal line, which I will make it slightly dark, and we know that whatever was this support was the higher bottom of the time. And now at this value of approximately 50,000, if Bank Nifty were to ever trade, it would then form a double bottom. Now, from the perspective of a positional trader, the failure of the market to decisively break the previous high would lead him or her to the bias that the market is either a range or it is in a bull trend, but it is extremely weak. Regardless, such a trader would benefit staying on the long side as long as the market is trading above the double bottom, which is pretty close to the 49,500, 50,000 levels of the market. Such a trader who would have made this assessment that the market is in a range will be open to trading on both sides of the market, and this decision would be taken on the daily time frame. Once we approach the daily, we can see all the markings that we had created in the previous chart play out. And on the previous chart, the double top doesn't look so much like a double top, rather looks like a higher top, although the market stayed there only for a few days but did not give a very strong weekly close. And since the higher top, the market has corrected significantly to form a bottom which is no longer a higher bottom but rather a double bottom in relation to this price action. Now, once the market has created a double bottom, and we already know that the market is on the potential low of the range on the weekly chart, we know that we are looking to go generally be on the long side of this particular segment. And if we look closely, we can see that on the 10th of October, that is on the same day that Nifty formed an inside day candle, Bank Nifty formed an inside day but a candle which looks slightly closer to being a bullish harami. A bullish harami is a slightly stronger reversal pattern than the inside day candle. And what do we need for confirmation? We first of all need a green closing and a closing significantly above the high of the reversal candle. We can see that on the 8th of October, when the market did create the bullish harami, on the 9th it created an intraday high but failed to close significantly above the previous high, and also previous high means on the high of the reversal candle, and also failed to give a green closing. However, both these criteria were met in the price action yesterday. That is, the market not only closed in green but also closed significantly higher than the candle which had formed the reversal. And further now, if we add the oscillator just to check on how we are placed, we will reduce the setting to 5 because we are reducing the time. We can now see that from the conditions of being highly oversold, the index has moved in the support territory. Therefore, it becomes now logical to bet on the long side of Bank Nifty because it has given the confirmation, and wait for Nifty to give the confirmation. In all cases, reverting back to Nifty chart, in all cases we can clearly see that the market, while in a pullback, has not changed its trend, and that the market continues to form a higher top, higher bottom. And as long as this is the case, our general bias must be on the long side. I have also told various students that regardless of what you do in the market, make sure you at least create one system which benefits from a trending upward market. This system can be deployed on its own merit while the trader can use the time, learning, and experience from such a system to create more complicated systems to capture the market changes in price with greater specificity and nuance. To understand how bullish a bullish market can be, I was just having a look at the historical chart of the S&P 500, and I tabulated these findings on an Excel sheet. Simply because I wanted to keep the year 2025 as a reference, I started the data from January 1935, at which point the S&P 500 was valued at $10. Next, I have marked the value of the S&P 500 over 5-year interval, where we can see from 10 it moved to 12, from 12 14, 14 17, 17 to 35, and so on, all the way up to its current value of 5,750. On the right hand side, I have marked the percentage change in relation to the 5-year period, which means from Jan 35 to 1940, the index moved up 20%, and from 1940 to 1945, the index moved up 17%, which is very interesting because during this period 35 to 45, and particularly during the period 40 to 45, the index was the world was going through the phase of the Second World War. So even during the Second World War, we have a case where one of the major indexes of the world actually returned positive, generated positive returns for its investors. So for all of us who are concerned about, let us say, the escalations in tensions between Israel and Iran, or between China and Taiwan, or between India and China, we have precedents, at least in this case, that there is at least one major economy which generated positive returns during the Second World War. In fact, we have to see this in perspective, that this economy generated positive returns during the Second World War, while the returns on an absolute value are just 17%. However, its alpha in relation to the other indices of the world would have been absolutely substantial, which means that in a phase when generally the quality of life all over the world reached a low, to generate positive returns from the market would have created a huge differential between the investors of this market versus individuals who are either out of the market or simply not in this geographical region, the US. Anyways, let's proceed. From 45 we move on to 1950, which is at 17, 35, 55, 85, and so on. And with this, what we have here is basically the percentage changes over a 5-year period. And over a 5-year period, we can see that the index has nearly at one point in time given 200% returns, and that was from the phase January 95 till January 2000. We know that from the period 95 to 2000, the commercialization of the internet had already started, and we also know that just prior to 95 was the major Gulf War and the balance of payment crisis and the unification of Germany, or the collapse in the Japan market, or the collapse in Soviet Russia, that is from the phase 1990 to 95. And we can see that even during that phase, the market could generate 40% returns on dollar terms, which is absolutely substantial. In fact, there are very few times in the market's history, that is from the period 1970 to 75 and from the periods of 2005 to 2010, where the markets have generated negative returns. So that it is clearly visible, I will just change the conditional highlighting and highlight those years in which we have had a negative return. So this is over a 5-year period. Next, I did a 10-year period check. When I do a 10-year period check, I use the reference year as 1940. And from 1940 to 1950, we can see a 42% increase in price. From 50 to 60, a 224% increase in price. 55, 27, 206, 323, 173, with only one decade in which the market generated a negative 20% returns. This is the decade that coincides with the subprime crisis in the US. What do these readings tell us? These readings do not give us a definite value for anything related to our markets. In fact, these are just past readings. But what these readings do tell us that when an economy is in an uptrend, the stock market has in the past and could potentially generate as high as 300% in a decade. And this 300% that it has returned, it should be noted, was in the US dollar terms, that is in the dollar currency terms. Since generally during this period and historically the dollar has appreciated vis-a-vis other currencies, it is safe to assume that a 300% return on US dollar terms will be significantly higher experienced in local currency terms. So given that we have seen that the markets change anywhere between minus 20 to plus 300%, and that in general, I mean, it's just taking a rough estimate, the markets have almost doubled every decade, we should expect, at least by using just one reference and very limited sample size, that it is possible that even our market could generate such a return. And therefore, I have always requested students to create at least one system which goes entirely long on the market, which means that if the trend is up, you will buy the dip, but if the trend is down, you will simply stay out of the market. Such is the nature of a long trending market, or a directional trade in the long side only. Now, when we have an understanding that 320% is the highest in a decade, we can simply move back to our chart on Nifty, and let's assume the current year to be 2024 or 2025, just for the ease of calculation, and give the Nifty an estimated value of 25,000. Now let's go back to 2015, and in 2015, which is quite some time back in this chart, the start of 2015 is right around here, we can see that the market was pretty much at 8500 levels. And so this here is the region that I'm mentioning as 2015, and the current valuation of 2400 is 200% returns from the market in a 10-year period. 200% returns, as we have seen in this chart, is possible. For example, the US market did it in 1960, it also did it in 1990, it certainly did it in 2000, and has nearly achieved the same in 2020. So 200% returns in a decade period seems to be fairly standard for a bullish trending market. But our 2% has come on the back of a declining currency. We all know that at around 2015, the US dollar was pretty close to 70, but today it is pretty close to 85, which means that there is a 15% dip in the currency, which needs to be subtracted from the returns. So a fair currency value would be 150% to 175% returns in rupee terms from the year 2015. Let's take this further. Let's go behind and check the value in 2005. In 2005, we can see that the market was at 2000, whereas in 2015 the market was at 8000, which means that from this period 2005 to 2015 the market generated over 300% returns. And of course, in the same period from 2005 to 2015 the market lost almost 50% against the US dollar compared to the current 15% against the US dollar. So logically, the 300% returns when adjusted for currency would seem closer to 250% returns. But also from the period 2005 to 15, the average inflation was around 10%. And if we subtract that, we will see that the returns would feel closer to 50% in a decade. Whereas in the current scenario, the average inflation is about 5%. and if we were to subtract that from the market, we would get a valuation of 100% from the stock market, implying that in absolute terms 2005 to 2015 was a better phase for the market with 300% returns compared to the current 200% returns. But when we adjust it for currency devaluation and general inflation, we can see that the last 10 years have been actually more profitable than the 10 years preceding that. And now, just to complete the sample, from this value of approximately 2000, if we go back all the way to the start of the data, which is actually which is for incidentally till 95 in November, we can see that the market was approximately 900 to 1000, which means that from the period 95 to 2005, the market generated just 100% returns. And this was backed in an extremely poor phase where the market had lost, where the currency had lost more than 50% in devaluation, and the interest rates were significantly higher, closer to 15% on an average. Therefore, it is reasonably safe to assume that where the precedence has been set that the markets can generate 300% in US dollar terms, we should not be surprised if something similar happens in our markets in the coming decades. Given the above, my view as an investor has not changed in the slightest. In fact, as an investor, I am only considering where do I buy. And as an investor, logically, if I would have marked this position as a higher bottom, I could simply use Fibonacci retracements of some type and connect it to the higher top and extend this value to see that the market is currently trading at 50 to 61% Fibonacci levels in relation to its previous bottom. Prima facie, this looks like a positional support to me and encourages me to add investments in the market. Of course, if I were to buy using this approach, I would have to exit at the break of the previous double bottom, which means that if I were to buy at the current approximately 25,000 levels, I would have to exit at approximately 23,500 to 24,000 levels, which is roughly 4 to 5% stop loss at the index level. Since stocks in general have a 2 to 3x beta compared to the index level, this will constitute to approximately 15% stop loss at individual stock level. Of course, the scenario changes entirely if the individual is trading smaller time frames, such as the hourly. And in hourly, since we do not have the advantage of generally seeing live highs and live lows routinely, I typically tend to use a mechanical indicator called as the ADX DMI. I set these color parameters to my comfort because I'm used to these values, and all I will do is I will try to interpret the trend on the hourly using the mechanical indicator. The reason being, the price action changes a lot within a range but not significant enough to alter structural trends. And in this we can clearly see that the ADX value is significantly below 25 at 14, which means that according to this indicator the market is actually in a range, and both the negative and the positive DI are below 25, indicating that generally in such a phase of the market we would prefer to write options, deep out of the money options, the closest being 25,400 calls and 24,700 puts. Typically we will see that the DMI or the ADX will only start increasing in value when such levels are broken. I generally use visual patterns for recognizing and identifying trends or moving averages when the time frame is longer. But when the time frames are shorter, because of the complexity of the price action that is formed, I rely on mechanical indicators to form an objective opinion. In view of the above, I hope I've shared some points which may be of use to you. I wish you all the best for your trading week.